The Hedgeless Horseman here. It's January 23, 2023, and this video will be a bit about Magna Mining, which recently saw an interview out with Crux Investor, where Crux Investor interviews CEO and one of the largest shareholders, Jason Jessup. And as always, very informative from stuff from Jason. It's like I don't know. I think I've re-listened to it 3 times already. Same with Doc Jones interview. There's just so much, to digest. Oftentimes you miss something, then you have more time to think about the case, and then you pick something new up, and it's like because obviously every tidbit of information is can be really useful, because our job is, to estimate current value as best we can, and projected future value, and then convert that to a fair value estimate of what it should be priced at today. And then we obviously look at what the market is pricing it at today, and if it is significantly undervalued in our opinion, then that by definition becomes a buy for a value investor. So just a few things I wrote down, notes, let's say, while listening to the interview, and I probably forgot some notes. I if I listen to it again, I would probably write down some more stuff, but just a few things at least. Jason is asked about FNX mining. It's like, what is your expertise? Why? What is your background, let's say? And he talks a bit about FNX mining, which was kind of like the original Magna mining, one could say. I don't remember when they said the company actually first started, but Jason was involved with Magna for 6 years, and a bunch of other guys, especially the geos, which are now with Magna Mining, were also along for the FNX story, and helped make that into what was apparently the best performing stock between 2000 and 2010 on the TSX. The best performing stock. It went from a low 25 cents per share to a high of $39 per share at its peak. Now that is value creation. And obviously, value creation takes time. But if you would get even, 10% of this kind of run, and it took like 5 years, that would obviously be way above market returns. Way above. So that is also, the things like, how do you capture the alpha of a superior management team? That is, time. The longer you hold a stock, if you hold a stock over 1 year, a superior management team are expected to have created X amount of value. So by definition, one would think that the value creation would correspond or correlate with your share performance. Obviously, if you start off cheap, that's even better, because then you have to first catch up to current value, and then you have a uptrending value curve as well. But it just by definition comes down to, again, like time held. If you own a percentage of a company with a bunch of value creators, they will have created more value over 3 years than 1 year. That is, obviously the base case. So you would expect the longer you held such a stock, the better your returns would be. And of course, there's going to be a bunch of volatility in the meantime, and we don't know in terms of broader market sentiment and commodity gyrations, etc. There might obviously be a case of you actually buy when it's cheap, but let's say the metal in question, or the the metals in question are at what we learn in hindsight are highs for the next X amount of years. Still, if they create value, and especially if they start off with a good asset that could work in almost any metal price environment, the risks are still to the upside. Because if they just keep creating value, let's say, if the metals do very poorly, maybe you'll actually be even at least, and the rest of the sector will be, let's say, down a lot. If it's a favorable metal environment, you might have absolutely, bonkers returns, akin to something like this. So, I mean, it's all about, in my opinion, stacking the odds in your favor, and that's why, again, superior management team, how you stack the odds in your favor is time held. Um, Anyway, they talk about bringing on a second drill rig sometime in the next couple of months, like 3-4 months. That sounds good. I mean, it's good to have one rig drilling, more shallow holes near where they might be bulk sampling or toll milling or starting production, etc. But you also want to follow some of these, rich zones to depth and expand, etc. Because we know that what Valley and Income mine, they mine down to, I think, 12 to maybe 1400 meters depth in the main zone. And there's a bunch of other zones to follow up, so we don't know how much more the current resource might grow. I mean, yes, right now it's like 31.5 million tons, I think. I expect that to grow. Let's just put it like that. So yes, today 31.5 million tons. With more drilling, I think we will add even more resources. That's obviously value creation, and if you have pretty much the best geologists, exploration geologists, that increases the odds of value creation actually happening. Footwall deposits, we know there are at least the 101 footwall zone and the 109 footwall zone, and both of these have produced obviously some insane results like this 98.3 meter intercept. I think that's an AU equivalent of 9.8 grams or something. I mean, just an obscene hole, obviously. And within that, high grade, very high grade nickel, high grade copper, bonanza grade precious metals over 7.1 meters. I mean, this kind of ore obviously would be profitable in pretty much any metal environment you can think of. I mean, the precious metals alone, it's bonanza grade. The nickel is bonanza grade alone. The copper is at least high grade alone, and you get all three in one hole. So, I mean, even if, let's say, nickel would crash 100%, this would still be probably economic, very economic mining. If copper would crash, obviously it would still be economic. If platinum, palladium, and gold went to zero, you have bonanza grade nickel and copper, and would obviously be profitable as well. I mean, that is what I really like to see from a risk mitigation standpoint. A great asset that could be, cash flow positive, even if metal prices just take a big dump and a lot of other producers might not be profitable, let's say. That cushions the downside. And they are copper and PGM rich, which you obviously can see here. High grade copper, bonanza grade PGMs, and can have appreciable nickel. I think it is I guess it's that 109 zone, footwall zone, that actually can have very high grade nickel as well. But there's a larger envelope where the PGMs are high, because this is 98.3 meters of 7.2 platinum, palladium, gold. So that's high grade precious metals with copper and nickel. But within that, there's bonanza grade nickel. So again, it's like, if you would bulk mine this kind of mineralization, I mean, again, this is most of the value in this is from the precious metals, not even nickel, but within that there's very high grade nickel and copper. And I think the 101 footwall zone is more, has, I think, lower nickel overall. So that's the beauty of it. When you think about it, it's like they have a very flexible metals mix in one mine. One could say there's, depending on what they want to focus on, and they did this apparently with FNX mining. In times where nickel prices were high, they focused on mining the nickel-rich stuff, getting the most for their ore. When nickel prices went lower, they mined more PGM type mineralization and copper, etc. So it's like, a big waste would obviously be, let's say you are operating a gold mine right now, you have 5 years of mine life, and you barely make any money on the gold. Maybe let's say you lose money. That was obviously a waste of time. You produce a lot of gold, so that it gets taken away from from the books of the company, and you make no profit. So let's say gold then suddenly takes off. You have no gold to make money because you sold that when you didn't get much for selling it. So I really like that. That obviously is also a risk mitigator. Because, again, there's like a PGM-rich mine and a nickel-rich mine in one deposit here. So we're not tied really to the fate of just nickel or just PGMs. If they can simply just switch where they are taking the ore from. It's like, okay, in a time of high nickel prices, obviously you'll get more for your nickel ore. Take advantage of that. If PGMs shoot up, because some expect both PGM and nickel to do very well over the coming years. You could basically, again, make sure to get the most for your ore, let's say. And also one thing here is like both footwall zones are in Sudbury Breccia, one being nickel rich and other nickel poor. Well, I'll get to that later. But these start off at surface or where is it? Yeah, basically at surface, at least the 109 here, and this is near surface. So this is stuff they could get into quite quickly. He also talks about sees production as low risk. That goes down to their expertise. If I remember correctly, they said that they actually put some mines into production, I think even without a PA. I see junior mining companies who fail even if they go into production with a PFS or a feasibility study. We've seen a lot of juniors go bust. These guys, due to their competence, obviously, experience, and I guess the characteristics of these Sudbury deposits, they were able to put a mine successfully into production without even an economic study. That is pretty. That is I think highlights just the competence that again led to this kind of value creation. Just obscene, obviously, because most went the other way. Even if they had a PFS or feasibility study, they went to. Some actually went bankrupt. And he also talks on that point about does not want to take on debt before being an established cash flower. And that is also, again, from a long-term investor standpoint, that is really good because let's say there are some tough times for some reason, and you have a lot of debt. Then you actually risk bankruptcy because let's face it, if you owned, and apparently you can pretty much sit on these holdings forever if my interpretation is correct, based on the Paul Fowler's talk during the pitch presentation, where he said that the majors basically can sit on their ore for until the end of days. So let's say, again, what is the risk of a long-term investor here? So let's say everything crashes or capital markets totally seize up, whatever. If you don't have any debt, the value doesn't really go away, obviously, because this is still over 50 million tons that Magna has in Sudbury, Canada, of all places. So just to, I mean, imagine if you just own that. It's like, even if you start mining it, let's say in 5 years, and nickel prices are like 2-3 times higher. As long as you don't lose the asset, let's say. So, and obviously that is what I also really like. Insiders have huge skin in the game in Magna. They are not focused on their salaries, I would say. They are focused on making a big success out of the company, because their shareholdings, I assume, dwarf their salaries. And we as shareholders then would have the same, I mean, they have the same incentives as shareholders. So I really like that, not to take on debt before being an established cash flower, basically not risking something going wrong in the markets, or maybe for Magna, whatever, and they end up losing these assets, going bankrupt. So that is music to my ears, because I do not want to see such a, I mean, nickel PGM copper mines permitted in Sudbury getting taken off our hands. And also, I mean, the beauty of toll milling, if they go that route, I mean, they haven't put a firm, they haven't made a firm decision either way yet, which makes total sense. They'll know more when the PEA is out. We don't know if they, they might end up getting tens or $100 million in grant money. Obviously, all of a sudden, building their own mill could make a lot more sense. I mean, that's kind of implied if you get the actual grant money, I guess. So I mean, and I've seen some, I don't know, I guess he's kind of a basher, like, well, they didn't say they were definitely going to go into toll milling. That is not priced in anyway. If we for sure knew that 100% certainty Magna Mining could be toll milling 2% nickel or better within around 12 months at 1,000 tons per day, at these nickel prices, let's say, and copper PGMs, Magna would be extremely undervalued right now. That is my assumption. And I think Magna is extremely undervalued, so there's that. But when you think about toll milling, is basically, okay, you can pick and choose, let's say, how much ore would you want to send and process and pay for to get processed. So that's pretty nice. I mean, if the spare capacity is up to 7,000 tons per day, I don't know if they could actually be allowed to, let's say, use all of that. But it's, I mean, a toll milling situation basically means you have a very flexible, you basically have a, pocket mill with a flexible capacity. If you want to do 500 tons per day, you can do that. If you want to double that to 1,000 tons per day, you don't need to build another mill or upgrade the mill. You just send 500 more tons per day. You could go to 2,000 tons per day, maybe 3,000 in a full-blown kind of commercial toll milling situation. That is very nice, in my opinion. Because then again, you might ramp that up if prices are high. You might decrease that if prices are low, etc., etc. So I mean, again, from a, let's say, shareholder perspective and value creation perspective, I think that is actually really good. Obviously, you would want to, I mean, they want to fill their mill, for example, Valley and Glencore, because economies of scale. Running a half-empty mill, for example, that's a lot of wasted, sunk costs and energy and whatever. Doesn't probably cost that much more to just go at full capacity. Marginal extra cost. Because it's not like they have to build a new mill or anything like that. The ball mill will still spin. It's just that it will have more stuff. So I really like that, because that means kinda that the growth is kind of, again, flexible, because as soon as you build, let's say, an open pit mine or whatever, I mean, the mine plan is already done. You'll have, at if you have your own mill and at this capacity, maybe 5,000 tons per day, you can't really run it higher than 5,000 tons per day. And the mine plan is how you actually do the open pit. I mean, it's already decided, at day one, pretty much. But in Magna's case, again, they could, hey, we want to double production, depending on where you start off with. But let's say they start with 1,000 tons per day. They could probably, again, like jack that up to 2,000, maybe even 3,000. And they don't need to, I mean, again, with an open pit, there's just so much daily throughput you can do based on how the pits are designed. So that kind of gets more fixed. You know what you're gonna get out of a mine, pretty much, a standalone mine, because you have the mill at full capacity. The pits are designed that they can allow for X amount of throughput each day. You can't just double that, meaning you have double the amount of trucks or whatever, because that probably won't fit on the ramps, etc. So it's pretty exciting. Again, it's like, I mean, the growth potential here. If you have up to, especially at the grades Magna has, if you have, let's say, all the way, you can go from all the way from 0 to maybe 6,000 tons per day, theoretically. They also expect to prove up more context-style mineralization and find footwall deposits at Green Hill. Again, that is value creation. It's just that it's not only towards cash flowing situation. It's not just a case of, yes, we're monetizing, we've drilled everything up and now we're gonna monetize it. No, they're probably, I mean, hopefully they'll go into both cash flow, positive cash flow, and get the producer premium and everything, and be able to organically grow, which would also include just drilling up even more ounces, so the mine could be producing positive cash flow for I don't know, many years extra to come, let's say. Because he talks about that, Jason. I mean, if you just assume that out of the underground 14.5 million tons, if 10 million tons are actually recoverable in a mine plan, I mean, if you ran 1 million tons per year, mined 1 million tons per year, that's 10 years of 1 million tons per year production. I think that's around 3,000 tons per day, something like that. So that would be a substantial mine, and at these prices, probably tens, if not over 100 million in cash flow. Probably might even be considerably more than 100 million, actually, Canadian at least, for 10 years straight. So maybe somewhere along the current enterprise value for 10 years straight. That is, again, that is meaningful. And if you can explore and add a few more years, I mean, if you could have that kind of scenario and you add 2 million tons, that would be 2 current enterprise values in value creation in a producing mine, let's say. But one of the very interesting thing, and also from risk mitigation and growth potential, organic growth potential at least, Jason talks about the possibility of selective mining, which they apparently were very good at with FNX mining. So he just plays with the idea of, let's say, doubling, that you double the grade, and all of a sudden you're shipping again, because toll milling, if you pay to process, transport and process 1,000 tons per day, and let's say the costs are fixed. Obviously, you'll get double the production if you actually shipped 1,000 tons of 4% nickel equivalent ore. You could get that by also producing or shipping 2,000 tons per day with 2% nickel equivalent ore. But again, if you pay per ton, if you send ore at being twice as valuable as the resource average, obviously you would have much higher margins on that. Much higher margin. I mean, if you would make money, good money on 2% nickel, if you send 4% nickel equivalent, all else equal, all that would be, pure profits, basically. So the margins per ton could shoot through the roof. And just did, some just theoretical examples. Like if you would do a bulk sample and you would be able to, put 4% nickel equivalent, that could be amount to 72.6 million in revenues. I'm not banking on that, and that is obviously not the big price. But it's like even if they did 1/3 of that, that is still meaningful profits for a company Magna size from a bulk sample. And I just played around with numbers. Let's say, okay, you agree. We're gonna pay you Glencore a value, whatever, for transportation and processing of 1,000 tons per day over 350 days, and we are gonna selectively mine and jack up the grade of the ore sent to 4% nickel equivalent. I mean, this is pretty bonkers, but that comes out to a revenue of 508 million Canadian per year. And obviously 500 tons, half that throughput would be 250 million Canadian per year. That is just revenue. That is excluding costs, etc. But you get a sense of like, hey, geez, even with 1,000 tons per day, if you could selectively mine, etc., and kind of high grade the ore, incredibly valuable operation potentially, just from 1,000 tons per day, just from Green Hill. And that would be way lower than, I mean, you could do that kind of operation for a long time, because that's 350,000 tons per day. And if you have 10 million tons, let's say, of recoverable resources in just the underground portion, that's 30 years of mining. 30 years. Now, everything can't be selectively mined, but it's like, because when I first heard it, and he went on to explain that when he says selective mining, he doesn't mean high grading a deposit. When you high grade a deposit, basically you pluck out the eyes of a deposit. I thought about showing some kind of slide to show what I mean, but I know Brent Cook has gone through this in a presentation. Because miners typically do that during low metal price environments. They need to, let's say, stay cash flow positive. So if they have, let's say, 5 million ounces in an open pit deposit, let's say, and the overall grade is 0.6 grams per ton, and they don't make any money on 0.6 grams per ton when gold is at whatever 1100. But within that, or parts of that deposit, there's like a higher grade core of 1 gram per ton. So 67% higher grade, 67% higher value per ton relative to the average ore grade of the deposit. So in that case, some companies, they redo their mine plan and just mine the higher grade ounces. So in the end, they won't mine 5 million ounces. Maybe they'll end up mining 2 million ounces of the high grade stuff. And since, they have to, let's say, redesign the earth, etc., maybe sometimes they kind of destroy the leftover value, meaning that if and when they actually mine those 2 million ounces, it becomes impossible to mine the 3 million of lower grade ounces that are still there, because they have, I mean, from a technical standpoint, I don't exactly know how that happens, but I hope you get what I mean. Maybe they mine an area that's like, okay, if we mine this out, we can't even, do the pit larger to actually recover the other stuff, or underground. Maybe they remove something so there's no support or whatever, so you can't even access the lower grade stuff later on. But basically, high grading means you pluck out the eyes of a deposit. So instead of, let's say, again, instead of having the full blown 5 million ounce recovered gold scenario, you only recover 2 million ounces, and you won't be able to recover the other 3 million ounces, even if gold prices go higher later on. So yeah, again, you just mine the best stuff because you need to, and then you lost, one could say you lost 3 million ounces. But you at least make a profit on the 2 million ounces you do mine. So that's kind of, again, that's like plucking out the best bits, and then you forego the lower grade stuff. So you will not be able to produce the 5 million ounces, but you at least will be, let's say, be able to stay cash flow positive on the 2 million ounces. But you kind of destroyed your longer term production profile by doing that, because all of a sudden the 3 million ounces you planned to recover as well, you can't recover anymore. So you will need to replace or find 3 million ounces more in addition to the 2 million ounces you actually made, even though you only mined 2 million ounces. But selective mining is different, and he talks about sharp-walled veins, I think that's what he called them, meaning that it's apparently quite easy to see where the ore is. And if we look at these, I think that mainly goes for the footwall breccia, the footwall zones, the breccia zones, because here you have the more typical, here you have the main zone, etc. This is more massive sulfide. Basically, this is kind of all ore. But in these footwall deposits, you have these, you can see these enormous, well, yeah, I mean, given the size here, I mean, some very, very large, totally barren boulders. And you have the actual mineralization, which contains all the actual metals you want to recover, that snakes around, wraps around these huge barren blocks of rocks here. That's just crushed rock, basically. So this has an ore grade of 0. 0 nickel, let's say 0 copper, 0 PGMs. But around it, there might be very high grade nickel and PGMs and copper. So, okay, what does selective mining mean? Let's take a look at, this is the block model. So let's say you have all these blocks here. Basically, think of it as cubes. I mean, for example, if let's find it. For example, let's say this here is. I should actually write on this. I can't right now, but let's say you have a block here, which is half barren rock and half mineralization. In that case, if the mineralization grades 4% nickel, the actual ore, and the barren rock grades 0, obviously, but makes up 50% of that block, that is going to have a grade of 2% nickel equivalent. Because 50% is absolutely barren, and the 50% is made up of 4% nickel equivalent. If you simply do not transport the barren rock and only take the mineralization, you obviously have 4% ore all of a sudden. So by just sending the mineralization, you don't high grade the deposit because there is no ore in this. This is just something that would be waste to send to the actual mill, because you're going to have to transport and crush this, and there's no metal to recover from it. So if you send 1,000 tons of stuff with 50% barren breccia rock and 50% made up of 4% nickel equivalent ore, you would have sent 1,000 tons with an average grade of 2% nickel equivalent. But imagine if you do not send and pay for processing and crushing and transportation of these barren breccia blocks here. You only take the actual mineralization. And let's say that mineralization actually grades upwards of 4% nickel equivalent. Again, that is not high grading, because you don't throw away anything that was ore, because this was always barren. But in that case, you would send 1,000 tons per day of 4% nickel equivalent. Again, without destroying any value, you would still, let's say, potentially double the grade of the ore you ship, and thus your margins would get jacked up by a lot, obviously. And this is actually a Sudbury breccia picture when I Googled for it. So again, let's pretend that these are all barren. Why would you send, I mean, let's say all of this is made up of, again, 50% ore, 50% barren rock, and the ore, let's say this is the ore here in the matrix, and that's grades on itself. If you just tested this would grade 4% nickel equivalent. But if you assay and drill all of this with 50% being barren rock, the grades would say that, hey, okay, this block here has a grade of 2% nickel equivalent. And that's true because it gets diluted by barren rock. But again, if you just didn't ship and pay for crushing and processing of these barren rocks, and you only ship the actual ore, all of a sudden, without destroying anything or throwing anything away except barren rock, you would be sending, let's say, 4% nickel equivalent mineralization to be processed. So that is a very intriguing thing. And again, the 101 footwall zone and the 109 footwall zone are in these breccia type situations. Here you don't have any waste. You can't high grade this, or you can selectively mine this, let's say. But in these zones, take this intercept for example, 98.3 meters grading this. Let's say a big part of this here is barren rock, and they can throw that away. So in reality, the ore in this area here is actually much higher grade. It's just the dilution that dilutes down the actual grade. So if you don't send the actual blocks here and just send the mineralization, maybe that's grading, I don't know, 1% nickel, 1% copper, 10% platinum, palladium, and Au. The actual ore, the actual mineralized ore. And if you again have a block model, have a block model, that's going to include a lot of waste rock. But nothing is lost if the block model says that this is 2%, 1 ton, or yeah, let's say 1 ton of 2% nickel equivalent. If you just don't process the barren rock here, you don't and send less ore, less tons to the actual mill, you didn't waste anything. Nothing disappeared. It's just that you didn't send the barren rocks. So you might send, again, instead of processing the whole ton, you send half a ton, 500 kilos. But that contains all the mineralization anyway. So even though you send half the tons, you capture all the mineralization. And obviously in that case would jack up the grade of the ore, let's say 1,000 tons per day that you send to the mill. So again, that opens up very interesting options, and especially given that both these zones are ones that would be some of the first zones that would be mined and, let's say, bulk sampled and toll milled, etc., because they start at or near surface at least. And both might offer the opportunity of selectively mining and throwing out the barren breccia blocks and jack up the grades. So when you send, instead of sending everything here, you send only the mineralization. And maybe you could squeeze in, again, in 1,000 tons per day, maybe you could squeeze in all the mineralization and the same amount of metals, which you, if you processed and sent everything here, you would need to send twice as many tons to process to get, again, the same amount of mineralization, the same cash flow. You just cut away 50% of rock and send twice the grades of ore to the mill. So imagine there's, I don't know, 1 million tons in here of 2% nickel equivalent grade. And you could shrink that tonnage by 50%, still capture all the mineralization, and send away ore to be processed and sold that grades double the block model grade. Imagine the kind of cash flow you could get from even a very small operation if you sent 4% nickel equivalent grades. That again is, I don't think is possible in the actual, massive sulfide zones. So that, like I said, I mean, these might be, well, in reality, actually, I mean, from a value per ton perspective, these results might be better than even though these results are absolute barn burners, some of the best holes that's been drilled in the entire sector. But let's say you could actually selectively mine this, so the actual, recovered grades are actually higher than even these bonanza results, or higher grade to bonanza results here. So that's one way to, again, just think about it. And if you just used, in that case, I'm just playing around with a 500 ton per day at twice the nickel equivalent grade. Imagine having a revenue of this, and I don't know what the actual margins would be, but for a company the size of Magna, just 500 tons could obviously be material. I mean, if you even take away 70% of this, that would still be material. And that's from 500 tons per day, assuming you could selectively mine this. And they, again, have done that before. Plus, another positive. One zone is nickel rich, another zone is more PGM rich. So if nickel is doing well, you could selectively mine this, get a lot of value from the nickel. If nickel prices are low, you don't want to waste selling your nickel in a low nickel price environment. You'll selectively mine and, quote, high grade the ore in this more nickel poor zone, let's say. And you save the nickel in this zone for when nickel prices are higher. And again, opposite direction, other side of the coin. If nickel prices are high, you'll process this nickel ore until it might go down, and then you don't want to be selling nickel at 15,000 tons dollars per ton. So you mine this instead, and then when nickel goes up to, let's say, 25, now it's closer to 30,000 tons dollars per ton, you'll mine this stuff again. So you maximize the value of the ore in this mine. And obviously, in that case, you could be flexible. You could react to the market, metal price environments, because nothing is really fixed in that case, not even the throughput, let's say. Let's say nickel goes to the moon and you go from 500 tons per day to 1,000 tons per day, and you just can produce that rate for 2 months when nickel is at $40,000 per ton, let's say. That would be a material impact, especially starting off from a market cap and enterprise value that we have, even from just 2 months of, let's say, very high nickel prices. And let's say they crash after that, down to 20,000. Then you might be mining some of the lower nickel stuff. Then it recovers, goes up to 30, 35. Then you go back in here. So you don't waste the nickel when prices are low. Same ore, etc. You just get more money for your mine. Yeah, those were the main things, I guess. One last thing. It's like this is what FNX Mining started off with. In January 2004, the SJV partners declared commercial production at the McCreedy West mine. This mine funded basically the exploration and building of the other mines. Here you have million tons here. These are reserves, these are resources, and you have inferred here. This is not a lot of tons. 1.36, 4 here, 1.44 here. Green Hill right now has underground resources of 14.5 million tons. And what, like 16 million tons of near surface open pit stuff. And then we have Shakespeare on top of that. So I mean, if you compare where, I mean, yes, they are in commercial production here, but they actually needed to, drill up a lot, used a lot of cash flow for exploration just to increase the mine life. Magna right now has a lot, several times the resources that FNX Mining had in 2004. And this was the, when all was said and done. And that just took, I don't know how long that took, maybe 6 years or something, 7. Let's just say, okay, we're at 1 point, I don't know, 2. And let's say we reach half this, like $20 per share. I mean, that is more than a 10 bagger. And if that takes like 4 years, I mean, that's probably going to be one of the best performing stocks, let's say. And if nickel prices are really good, I mean, and they actually grow and put, the hub and spoke model in actual production and make another acquisition, it's like they could blow way past $20, I would think. It's like what Jason said. He said he's not going to sell a single share, and he's probably already more exposed to the price of Magna shares. He has, I believe, he has more tied up in Magna shares than any one of us. And he says he will not take any money off the table before Magna is at 1 billion. And like he also said, I don't know if it was a Crux interview or another interview, but yeah, I think it was a previous Crux interview where he said he sees, there's enough stuff left in the Sudbury camp for them to acquire, etc., that he sees, without stepping outside of Sudbury, he believes there's potential to make Magna into a multi-billion-dollar company. We're at, I don't know, 175 right now. Let's say round up 200. This will need to, 5x just to get to 1 billion. And he's talking about, longer term potential of multi-billion-dollar company. And at 1 billion, I don't think that would even be really expensive just based on the current assets. That's the, good part. It's like, yeah, okay, even if, especially, I mean, if this goes up 1 to 2 times, in light of everything, I've talked about here and everything Jason, etc. says and what we have on the books, I mean, I would say that is closer to fair value, not even overvaluation. And that's not too often you can say that. It's like some stock, I mean, those are the best cases, obviously, where you're like, hey, if this goes up 200%, I don't think it's even a sell at that point. Well, you might take some money off the table, but again, it's like, hey, Jason says, $1 billion is like minimum for what they, I guess, already have or what he expects they will have. Yeah, so anyway, it's like, Yeah, one of the, in my opinion, biggest no-brainers. It's right now is no, by some margin my largest holding, and there's just a bunch of upside surprise. Well, I shouldn't say upside surprises, but it's like, yeah, they've already started drilling. We know what kind of intercepts this system can produce, just Green Hill. And they're going to be drilling at Shakespeare. So we have, throughout this whole year, I guess we'll have news releases every 2 weeks or so of assays. And then we have the potential grant, and then we have potential bulk samples and potentially toll milling. In like 12 months, we have a PA, which is expected to be out in like 2-3 months or something. So there's going to be a bunch of value creation on top of what we already have. So I don't think this year will be boring. And again, we know what how the market reacted on these barn burners. I'm not. They for sure will not drill only monster holes like, I mean, like this. But I expect, some holes to be barn burners now and then, and some to be very good. Let's say they should obviously miss some holes if they do, real exploration like big step out hole exploration. But still, if they tag a new footwall zone or whatever, I mean that could add hundreds of millions of dollars. And if we're already starting off cheap just based on what we have, it's like they can do no real exploration and miss, and we will be overpaying right now because they already have 51 million tons. That's the beauty of it. It's like at face value, it's risk-free exploration upside, whereas in most exploration cases, the exploration risk is the risk. You bet on a deposit growing and growing and growing. If that doesn't happen, share price might go down 70%. If you have a mature play, you might think that is 100% undervalued to fair value, but they don't really have an exploration potential. Then you have a fixed expected return of 100%. If that takes 2 years, and they might not have created much value anyway, so you get, I mean, the expected value is kind of fixed at 100%. But if Magna is, let's say, 200% undervalued just based on what they have, and you have free upside exploration risk, I mean, those are the cases I think are the absolute best, where you have probable returns just to get to fair value, and then you have a bunch of upside potential from exploration and then toll milling, etc. Yeah, anyway, thanks for listening. Consider me biased. I'm obviously biased. I have a lot of shares in Magna Mining. It's one of the best cases I have ever seen, I think. That doesn't guarantee that we're gonna make a lot of money on it. It's just that the odds look favorable. Let's put it like that. And assume I might buy or sell anytime. So don't, again, do your own due diligence. Know what you're doing. You have to see the case, and you have to have your strategy. You have to have, I don't know, a fair value estimate in mind, etc., etc. They're a sponsor as well. So like, again, I'm biased. I don't share your profits or your losses. This is how I see it. This makes sense to me. This is how I think about it. And you'll have to form your own opinion. If nothing I say makes sense, I mean, you should obviously not do what I do in that case, etc. Thanks for listening. Hit thumbs up if you like this stuff. Bye.